Hi, Denise.
All right, so we're gonna start. So, welcome everybody. A lot of you I've seen before. Some of you are new. Some of you are our favorites. Welcome to Friday Night Lights. So we run this call every Friday night, 7 p.m. Eastern time. And what we like to do and try to do is do different things each week. Sometimes we bring folks on to talk about different topics. We had some brokers on. Sometimes we bring the topics. Example, a couple weeks ago, Teresa ran through some legal stuff. It was absolutely fantastic. We also like to do once a month, kind of like bring a deal. I don't want to steal Grant's bring your deal, so we're going to call it bring a deal, where we allow folks to just, if you want to practice, if you want to pitch to people, if you want to walk through and ask questions, if you want to get feedback. We did this about 4 weeks ago. We had three folks that did it, and it was great. It was a lot of back and forth. There was a lot of feedback for the presenters. There was a lot of great information provided to them. So that's what we're going to do today. We have two presenters today who are going to go. Vasily is going to pitch his deal, and then Kevin has his deal. He's going to pitch right after. We'll figure about 20 minutes to pitch, and then any questions that you guys have, you can ask them questions about their deal, and we can provide feedback to them as well. They are here not only to pitch their deal, but also practice and learn. So feel free to help them along, encourage them. And I also just like to always preface. So we do this every week. This is purely for educational purposes. We are not SEC lawyers. We are not financial planners. And we are not tax accountants. So everything we bring you here is from our own personal experience as well as the experience of the collective group. So thank you all. Welcome again. And Vasily, I want to turn it over to you.
Sure, let's
Is it?
go.
Let's
Well, I
go.
have this deal. It's on the Google Drive, so I'm gonna try to share. So I'm not sure if it's gonna work, but let's try.
And I will try and pull it up as well while we're.
No, it's not working. What about you, Jason? Can you pull it up?
Yeah, I'm gonna see if I can grab it. All right, so let me see if I can share my screen. You see my screen.
Hold
Yes.
on.
All right,
Oh,
and
perfect.
then make it a little bit bigger for you.
Perfect.
All right, you're up. And tell me when to
Okay.
change slides too.
Awesome, awesome. I'll let you know when to change the screen, the page. So everybody, my name is Vasily. My current location, Vancouver, Washington. So I met up with Jason in April at Grant Cardone Real Estate Summit. So we exchange information. He invited me. I told him I have a deal. He's like, yeah, bring it here, present it. I'm like, sure, let's do it. So yeah, it's I've been investing with this group of people, LP in in two different deals. This is my third one. They invite me to become a GP. I took this position. I'm like, okay, I will take this challenge. So yeah, this is the name of the deal, Lodge at West Oak Apartments, Houston, Texas. So maybe you guys know Houston, maybe not. So me personally, I actually flew out to this property, spent a couple days with my main GP people. So I took a lot of information, walked the property, beautiful property. I love it. Location, especially like right here, that's a private school, nice neighborhood, and it sits next to a Highway 6. So it's a awesome location, in my opinion. So price per union is 110 and a half and our purchase price 35.8 million and purchase cap rate 5.2, NOI 1,850,000. Our average rent 1,289, So replacement cost right now, from 180 to 200,000. So we're getting for a good deal, so 40% discount. So yeah, I like it. I love the property, location, and stuff like that. So Jason, next page, please. So asset overview, that's a kind of like a side view inside the unions. Again, pool, kitchen, awesome property. Just the way you guys see it, that's the way it is. It's nice and clean, awesome landscape, stuff like that. So again, lodge at West Oak, 324 units, Class A multifamily, built 1999, a value add opportunity, garden style community, current performance 80% occupancy, operational underperformance, physical profile, average unit size 885 square feet. This property sits on 14.1 acres, so very spacious, a lot of space. I like it. Um, Parking ratio 1.5, really like a lot of cars you can park. Um, Resort style amenity. So next page, please. Location, here's the address, so you can guys Google, look in, do a little research on your own. Again, this property sits to next to energy corridor and demand drivers, MD Anderson Cancer Center, Texas Children's Hospital, West Side, which is this property sits on the west side. Again, West Chase Business District's 1,500 businesses. Household metrics. Average household income 104,000 a year. Average home price 362,000. And investment signal, high income employment driven submarket with strong rental demand and limited affordability to own. Next slide, please. And our business plan, increase occupancy. That's our number one right here, because currently it's only 80%. Next one is upgrade 60 units and raising rent 50 to $100. But I think all of you guys are very knowledgeable over here, because right now rents are kind of flat, hard to raise. So our plan is, like, I personally played with a lot of numbers, occupancy that will create big cash flow and huge improvement in property. So that's going to be our number one goal to focus. And then increasing income, implement RUBS, capture loss to lease, improving. Can you go up a little bit? Yeah, improving operation, strain collection, reducing delinquency. So yeah, again, this is another view of the property. Has a pretty big driveway, nice landscaping, office, pool, all the buildings kind of like spread apart, so kind of really good for family. Next slide, please. And our investment summary. Again, price per unit, it's 110 and a half. IRR, it's for 17% plus. Cash and cash, 6%. And equity multiplier, 2.1. And capital structure, 25.8 purchase price, 12 million equity that we're raising right now, a million GP co-investors. Minimum investment is 50,000. Investment, investors distribution 75-25 LP/GP split, quarterly cash flow, participation in sales proceeds. Our a plan to hold this property to 3 to 5 years. And this investment is open for credited and non-credited, so basically friends and family. Next slide, please. And we're planning to close this deal in July. So yeah, next slide. Yeah, and the main guy, Reg, he found the property. He did all the connection and building relationship with the broker and getting this property under contract. And here's myself. So if you guys feel free to connect with Reg or me, any questions and stuff like that. So this is it. That's a awesome property. And again, a little story actually about this property. This guy currently owns 42 of those assets. So he's 77 years old. He's a big developer. So he built himself this property since 1999. So there's no loan, no debt. It's free property. So he wants to liquidate five of them. So we got one deal under contract. It's just kind of a little story why they're selling the property. So yeah, if any questions, ask please.
All right, who has questions?
I have a
So
question.
go
Absolutely,
for
go
it.
ahead. Go ahead.
Hi. Um, yeah, so I see that's 80% owner occupied.
Hmm.
So, is the seller going to help with the loan, or how do you propose to get a loan?
No, we already got a loan.
Oh, really? At
Hmm.
80%? Oh, okay.
Yeah, yeah. Because the Reg, they currently own eight properties. This is our ninth property.
Oh, okay.
Yeah.
What's the rate on the loan?
I believe it's four something.
Oh, pretty good. Okay. Yeah, that was my question.
No problem.
Yeah, thank you.
Believe it was on slide 4 where you were talking about the plan to renovate 60 units.
Hmm.
How so out of the 300 and was it 34? How many are currently renovated and how many are at I guess the classic
There's
or
some of them. I'm not sure on the percentage, like how much percentage they've been renovated, but they're just empty. Because I visit some of the units, they're literally ready to move in, and some of the units they just need help, like new carpet, new fresh paint. Some of the faucets, they're just empty, vacant.
gotcha. Thank you.
And like I said, this property, there's no loan. It's mismanaged, and the guy just doesn't care. It's still producing a lot of cash flow. So that's kind of like, caught our attention, and we see a kind of like a business plan that we can, you know, increase and bring value to this property. That's why our goal is to hold this property 3 to 5 years.
What happens if you don't hit your increase in occupancy?
Even we tried kind of like test.
Mhm.
I mean, it's just gonna take longer to hold the property.
Can it like so can it what was the stress test? Like what occupancy rate can it handle based on what your purchase price is?
Like 60.
60. Wow.
Yeah.
Okay. And then your statement about the rents, right? Rents are kind of flat, right? So
Mm-hmm. Yeah, yeah.
you don't think that you can get the 50 to 100 bump?
We might.
Okay. Who else has questions? This is a nice
So
property.
what's your plan for property management?
We're gonna bring our own management company because we have our own management company. We actually have another property that we just bought it a year and a half. Um, Occupancy was only 74%, and the property is 30 minutes away from this one. So when I was visiting this property, so I went there because right now our occupancy is 94%. That property is doing absolutely phenomenal job, and our management team as well.
So are all
Yeah,
the other properties around this one? So like they're all located in Houston?
We have 4 properties in Houston, and we have four properties in Dallas.
Gotcha.
So these are going to be our 5th property in Houston. Because my main partners, they're like 20 minutes away from this property. Any other questions?
What's the economic occupancy?
Right now,
Mm-hmm.
80%.
Okay. So everybody's paying that
Yeah,
lives
yeah.
there?
Yep. Because right now, like on the market, this value of this property is 38 million. If you do like underwriting with all the numbers, that's the way it is. So that's
Beautiful
why
property.
we see it's a good deal.
Do you
Thank
have
you.
this under contract yet, or have you
Yes,
submitted an
yes.
LOI on it?
Yep,
It is under contract.
yep.
How long is your due diligence?
No, due diligence all done.
How long? So have you gone hard on the money now?
Yeah.
Okay.
So our goal is
When
right
do you,
now to just raise and close the deal.
Where are you at?
when do you,
Vasily, it's Kevin.
Me,
Oh, I'm
me
sorry,
per,
Tim. Did I just talk over you?
me
I was just
personally,
going to
I'm
ask when
located
do
in
you,
Vancouver, Washington.
I was just going to ask when you thought to close, when you were supposed to close on the property.
We're planning to close in July.
Where are you at the raise so far? I know you have to raise $12 million. How much more is
We
left?
raised 7 million right now.
Wow, very good.
Yeah.
So I've got a question on your exit strategy.
Mm-hmm.
You're looking at a 6.2 cap rate to exit. Well, I mean, this is just pro forma, right? But that's a big hit from
No, we're planning to exit at 5.4.
5.4.
Yeah, cap rate.
Okay, where am I looking at the numbers?
What's your going in cap rate?
5.2.
Okay.
Is that normal?
That's what's cap rate on the market right now. And that's how we did our underwriting with
Okay.
5.2.
And you're looking at exiting, you said 5.4.
Yeah.
Okay.
Because we're trying to bring value up to like 50 million. As soon as we hit that target, we're gonna exit the property.
Okay. You're at the 9 o'clock in Houston. That's a good area.
Yeah, I have two guys, two GPs that are like 30 minutes away from this property.
Nice.
Yeah, so they know this location very well. If you guys are like really interested, I can help you guys to connect with a main guy, and they can help you guys to understand.
Are there any concessions in the area of other properties or any competition for renting?
Well, at this property, I rent actually a little bit lower compared to neighbors' properties. So our like the
Oh,
way we
some
did
similar.
underwriting, just focusing like we're gonna try to like apply a lot of energy on the occupancy, keep the rent same,
Mhm.
but just bring the occupancy. If we bring the occupancy 90, 92, 94, we're gonna hit our target really fast.
Yeah. Okay.
Because like me personally, I came out myself and I spent 2 days over there. So I visit 27 units and I ask all those tenants, uh, they are a long time. Like I found people 5 years, 14, 8, and I think I found only a couple of units to like 8 months up to a year. But the rest are a long time. So the number one complaint from tenants, I asked them like, what's number one complaint? You're sick of it. It's like the maintenance.
Oh,
It's just too long. You complain for something is broken and leaking, and it just takes weeks to get repaired, done.
Your management company, you've got an in-house management company.
Yeah.
How long have they been operating?
3 years. Yeah, Cross 7. That's the name of the company.
Awesome.
And like I said, this group of people, they have 8 properties already. This is our 9th property, and this is our first Class A property.
I'm excited for you.
Thank
Yeah.
you. Thank you. Well, this is my first time being a GP. I was always LP.
Oh, you're doing great.
Yeah,
Yeah.
thank you.
Good
Thank
job,
you.
Vasily.
Yeah, great job. Any last questions for him?
Yeah, say something if I said something incorrectly or presented something. Please tell me. Help me to be better. Smooth.
Did you have the graph where it showed the 1 through 5 years?
Yes, I do. I have a different pitch deck. If somebody is interested, I'm gonna
Oh,
post
okay. Yeah,
I
more
can
in
send it
depth.
to you guys, like
Yeah,
with more details.
he has a 42-page pitch deck. So
Oh,
we
wow.
figured
Yes,
we
very like
figured
a
that
very
would
deep.
not be, yeah, that would probably take too long to go through. So
Hmm.
but it's very detailed, so I agree. Like if you want to, here's his information right here. Reach out. I did the QR codes, they go right to the website. They're great.
I need to LP on a team so I can move forward.
That's right.
Vasily, you're
Well, great
saying
job. I think it's a
this
beautiful
is a
property. Reach out to Vasily if you have any questions. And let me stop sharing. Great job.
Thank you.
I think overall you did a good job. You had all the answers. You visited the property. You understood what everything that was going on about the property. I would think it was a great pitch. It's very smart.
Thank you. Yeah, when I was invited to become a GP, I told them I need to fly in because I need
Mhm.
confidence.
Which is great because that's what we all did too. It's great to have been to the property and walk the units. So then you can
Yep.
actually speak to all of that.
Thank you.
Vasily, I've got one more question.
No problem.
You're saying this is a Class A property. It
Yes.
was built in 99.
Yeah.
Is there any CapEx budget for it?
Yeah, that's that 12 million that we're raising, that's part of the CapEx as well, because we're planning to put 1.3 million into the property.
1.3. Okay.
Yeah. We
Good
want to
job.
attract quality people.
Hmm. All right, great work. All right, next up is Kevin. You ready, Kevin?
I am, I am not. I'm still not home yet, unfortunately. I got stuck in this traffic thing.
Oh, you're still
Uh,
driving. Gotcha.
yeah,
Okay.
but you know what? Here, let's do this because I can talk about it. I have a crappy slide deck at home, but I know I graciously Tim did accept my pile of documents there, and I can speak to the property from what I remember, and certainly answer some questions about it. But first, Vasily, great job, man. What a great find. Love that property. Congratulations.
Thank you,
Um,
Kevin.
yeah, you're awesome. Right on. So what I found is for those of you who might have been on the Cardone mentoring call 2 weeks ago, I brought this property that I just received the documents on. It's in River Grove. It is a small pocket community just south of O'Hare Airport. So drivability wise, it's 15 minutes from O'Hare. It's a nice green area, a lot of forest reserve, parkways and stuff around it. It's probably, I would say,
Hey, Kevin.
yeah.
Hey, Kevin, you want me to share I've got the OM. Do you want me to share the
Oh,
pictures of
yeah,
that?
yeah, pop it up. Yeah, perfect. Thank you very much, Tim. Appreciate it. Uh, it is a 138 units. There's 5 commercial on it. The way I underwrote it, because I keep getting hammered by a lot of people in the 10x community certainly, but across the board, people are a little we'll just say hinky about the commercial component. Understandably so. I also, depending on what's there in the first place, uh, And one of the first things I noted is that one of the commercials in this property was a furniture store. By the way, can everyone hear me okay?
Yes, we can hear you.
Okay, I just want to make sure. Anyway, it was and I actually, when I walked the property the other day, I stopped in and spoke with the furniture store, the door store. I went to the cafe, and these are like boutique shops. Turns out the one commercial, the furniture store, they also have a door store. They are a global Ukrainian company. This is just one of their outlets. So it's like boutique stuff. And this is like in a working class community. Like I said, it's solid B. So this is like the chic intersection now in that community, if you can imagine. And to satisfy the desires of our great leader, Grant Cardone, there's a Starbucks a block and a half away. There's shopping within a quarter-mile walking distance, full supermarket. So the walkability of this is ranked on the walk score only like an 85%, but I would contest that simply because right across the street, in terms of its validity, is the Metro station, and Metro is the regional Chicago transit system, 25 minutes to the loop to downtown Chicago. So for anyone who's a commuter or, it's a transit-oriented community, so it's really got a lot of credibility. And one of the other things that's come up is there's a TIF attached to it. And once again, if you were on the call today with Ben and Chris Langer was on there as well, there was a conversation about TIFs. Now, for those who don't know what a TIF is, that's tax increment financing. And what that is basically a tax scheme set up to encourage development in certain typically not great areas or communities. But it also may be in areas that just need an extra boost and it's hard to get development in. Particularly in the Chicago market. Right now, development costs for a replacement cost for in River Grove right now is approximately $375,000 a unit for these buildings. In Chicago, it's going north of 500,000. So there's really a weird thing going on in Chicago. It's a strange market, but it is still a strong market. So it's my backyard, and there's a lot of potential here. We're at about 270, and Tim, you've got the numbers there. I think we're at about 273 a unit, so we're well below replacement cost. Cap rate 6.1 blended. They're asking 42 million, and my potential offer somewhere between 38 and 39. I'm still working numbers. I managed to mix up my underwriting, trying to do some fancy stuff, so I got to rework it all. And I also have some great people looking at it for me to try to develop numbers on it. So that being said, the returns are still in question because of the way it's going to be structured. I'm going to have to do about a $14 to $15 million raise, depending on how the final numbers work out in the underwriting. And it's I went in and Vasily was talking about how he went in and spoke with the tenants about what's the challenges there. And the guy in the little cafe downstairs gave me all the download on what all the tenants say to him when they come to get their coffee. And it's just normal stuff. And when I asked the property manager if there was one thing, if she had $500,000, what would she fix? The only thing she had to offer is she would add a pool to the top, to the upstairs. There's a beautiful deck upstairs, looks out onto the greenway. So it's just a great property. Like I said, I'll be bringing the numbers to Wednesday's club call and then again on Friday. If the numbers work, I'm going to be pitching this with Grant at his pitch a deal on Thursday or Friday. But I'll certainly, when I get to my desk here in about 5 minutes, I'll throw up my information. I think my information is right there on the screen as well. If anyone has any questions, go ahead, let her rip. Tim, if you have any input there, I don't know if you've had a chance to look at any of this stuff as well.
Yeah, I looked it over, but it was real rough because I just got it, so I hadn't really dove into it a whole lot. And I didn't know, like you just told me what they were asking and then kind of what you're looking at on your offer. So
Oh
I hadn't
yeah,
had those
yeah.
plugged in yet.
Let me expound. I apologize. I went into what a TIF is, but I didn't talk about this property specifically. Did a little research. The TIF was set up in 2013 as a 20-year TIF. However, it's got some flexibility in it, so it can be played out. Right now, the TIF is providing support for the NOI to the tune of about $600,000 a year. That TIF runs right now through 2037, 38. And that is that being, we'll say even 10 years now. The plan on this is to hold 5 or 7 or refi, cash out our investors and go infinity returns. And those returns yet, as I said, are still up in the air. For some reason, I thought it was going to be 7, but I can't be certain. But the plan is to hold this property as long as possible, because once that TIF runs out 2038, if everyone's cashed out, the reduction in returns is, I mean, it's infinity. So what does it make at that point? Unless there's a valuation pop in this thing that says, hey, let's just sell it, I would hold on to it as long as I could. That's it. Any other questions?
So how did you underwrite the retail space in that?
Excellent question. Thank you, Mr. Underwriter. So what I looked at, and I had the fortune of, this is a CBRE deal. And for those who aren't familiar, CBR is one of the top brokerages. They this just dropped out. They picked it up somewhere else, and I had the fortune of walking the property with their underwriter the other day, with one of their finance guys. So it was the broker and the finance guy walked it with me, and they were giving me all this, how just underwrite it this way and that. What I did is took the underwriting as 138 units, and then I just ignored the commercial as a unit and dropped it into other income. And
Did
left
you
it
use
at a
100% of what they had, or for just
well,
just the retail income?
that it went into other income. I put it into other income.
Right,
So is my 90, my 95.7% occupancy is just on the rents, just on the regular rolls.
right.
And then I dropped yeah, gotcha.
So what I'm
I
saying
guess I
is
could have
it's
done the other way.
144. What I'm saying, it's 144,000 income for the rent for the retail space, and I put it in other income as well. But did you use
Okay.
100% of that, or usually what I do
Yes.
on the retail space is I usually use half of that, just because
Okay.
retail is so squirrely. Just to be conservative, not to count on 100% of that income, going forward.
Yeah,
Just,
yeah. No, I appreciate that. That's a good stress test. And I looked at that and I thought, yeah, I guess I was being a little loose with my numbers there, because the confidence I had after my visit and my conversations changed drastically, but still no reason to. I got emotional, Tim. The
yeah.
Can I
death
ask a
knell.
question real quick? Can I ask a question,
Absolutely.
guys?
Absolutely.
Excellent. Tim, so I have a question. So could you utilize that 144 income and just underwrite it at a retail cap rate? So like, let's say the retail cap rate in that area was 6.5. So could you not value that at a 6.5 cap rate and enter it in that way? Or how would you, because you said that basically you just cut that in half. I was just curious if that was another way that it could be underwritten.
I mean, there's 1,000 different ways to do it. I just simplify. I look at retail as just like charging for parking, or charging for, laundry facilities, or, some storage. I just look at the retail as just another revenue source. But since it's retail, so a lot of those retail leases that you get, you can have a 10-year lease on some of those. But if any of those decide to go out of business, the lease doesn't matter. And depending on the kind of business that they are, some of them are more reliable than others. And I saw what they were, but I don't remember. I know one of them was a nail salon. I don't know what the other ones were.
There's a
Um,
yoga spa, a nail salon, furniture store, and the door store. Those two are the Ukrainian businesses. They're tied
yeah.
together. Same vendor, and then the cafe, which
Okay.
was actually really impressive. I was blown away by the guy who was running that.
Yeah.
So as a point of
And unfortunately,
reference, I one time pitched a deal to Grant that had retail in the bottom. And he asked me how I handled that. And I said, I didn't put it in at all because I didn't want to skew I wanted to make sure that the multi-unit was 100%. And he said, good, that's how I would have done it too. So
yeah.
take that for what
Yeah,
it's worth.
He actually said that on the call on Wednesday too. There was one, I think, a deal that somebody brought up that was mixed use, and he said
That was
either
actually
don't count
mine.
it either. Oh yeah, either don't count it at all or just count part of it, but don't count all of it. So
Yeah, I was just curious because a lot of people underwrite it differently, and it's just kind of good to kind of get other people's opinions. And
yeah,
you seem very knowledgeable, Tim. So that's why I wanted to ask the question. And
yeah,
thanks, Teresa, for adding that.
yeah. My philosophy is just to keep it simple, and you know,
Thank you.
and not count, not and keep it conservative as well. So
Yeah, and just to add to that, I think it's important to think about the businesses that are there, because if COVID happens again, are they going to stay in business? Is it going to
right,
be, you know, a company, a retail shop that nobody's shopping at? Everybody's getting their nails done. So, and
you know what?
hair,
If kind of
nails.
COVID
Huh?
happens again, I'm going for a bunch of free government money.
I think about
good
like,
luck with
okay,
that.
people still need to go there.
Well, then I'll open up a
So
testing store. Okay.
Kevin, a couple other things you might want to look at that I noticed in some of the numbers was the insurance that they had listed there
Yep.
seems extremely low.
If you look on
They
the
had
finance, it's 20 something, 22 on the
23,000. Yeah.
yeah, the offering, the CBR finance guy put it in at 38 or 39. I used his numbers.
I would use a lot more than that. So it's going to be, I would think in Chicago, and even though I know it's a newer property, it's a 2023,
Yeah.
right? Build.
Yep.
Yeah.
Yep.
I would still probably use $700 or $800 per unit, which gets it up closer to 100 or 110,000, because that's
Or
a
that
little more
high.
realistic. Oh
Okay.
yeah,
Okay.
it's
Yeah, I was trying to figure that out.
I
Okay,
think
that's good. Thank
I
you.
would think in Chicago it's going to be on the high end too. I mean, I
Well,
don't know
again,
Chicago
now,
that well, so
yeah, here's a curious thing about this. And I mentioned Chicago specifically versus this property. This is in Cook County, which Chicago is most of, but it is not Chicago. So there's
right.
a stark difference between the two. They're both criminal enterprises as part of a larger Illinois criminal enterprise. But still, there's huge cost
True
differences.
story.
It's just weird. So yeah,
Yeah,
appreciate
and
that.
Kevin, on that topic, I just got my tax bill today because I live in Illinois and I'm much further down south, but my tax bill is $8,200. And so I think that probably 700 per unit is definitely more likely than that lower amount. I'd be curious to see what that really is because those
Yeah,
suburbs, they're high. You know
So
that.
and
at 23K, it's $121 a door. And then so at 40, you're thinking double that. So it'd be like
yep,
250. So in our
yeah,
area, in our market, it's definitely more than that. But
Yeah,
if you're actually looking at the OM, you can actually see Chicago and you can kind of see that it's like a little bit out of the actual city. I was just
yeah,
going to point that
well,
out. So
yeah,
that's
yeah.
a
No, we're like
positive.
2 suburbs away. I mean, to give a perspective, within a 3 mile radius around the property, you hit on Chicago. Of course, O'Hare Airport is in Chicago, but Chicago, in the spirit of gerrymandering, kind of sticks out a little bit there and grabs O'Hare Airport, and then south of it is a bunch of suburbs. And between Chicago and O'Hare Airport is also more suburbs. So this is a heavily Eastern European area just to the east of there. And it is a solid working class community. If there's any of those left, this is one of them. So it's a solid community. I have great confidence in the endurance, I guess you'd say, of that status of the community. Another bonus about this property, and I'm looking into it right now, is directly across the street is it's a risk as well as an opportunity. There is a vacant restaurant. It was a long-term restaurant, community restaurant. It's only changed names twice in the last 40 years. There was a falling out between the operating partner and the property owner about a year and a half ago. It's since vacated and now on the market. And I spoke with that broker today. I'm an operator, just so you all know. I grew up in the restaurant business. So the potential there is for me to do a separate business acquisition to put like an American style cafe in that opportunity, simply because it's a high traffic area that comes down the road that goes past here. Thatcher is a main north-south thoroughfare on the west side of town. And then the east-west is Grand Avenue, which is also an east-west corridor out of downtown Chicago. So it's a pretty heavily trafficked area. And then you have the exposure to the Metro train station directly across the street. So there's an opportunity there, separate thing. And if you're interested in the restaurant business, hospitality, let me know. That's another potential.
You know how they manage this now and how you would plan to manage it if you got it?
Thank you. Good question. I have a friend who is a property manager. He's primarily in Wisconsin, but he's been kind of my walking partner on a lot of these properties. And he's doing some multi-units up in Milwaukee market. So he's my number one guy. But the management in place seems to be doing a pretty good job. They are hired by the developer. The developer's called Noah Properties. And they've got a few other ones up on the market as well. And these folks manage all their portfolio. It's not part of their company. They're just contracted by them.
I was going to say they must manage multiple properties close by because their management fee was pretty low too. I mean, they had about 89,000 in there, but
yeah, but if you look,
3%,
their labor costs
3%
are
is
pretty
like
high.
130,000. So they're about 40,000 lower. And so they're doing it pretty cheap. So they must be kind of merging it with some other properties that they manage in the area.
I believe so. I don't know the percentage wise. Again, I'm not at my desk, but if you look at the labor, that's pretty high. And then everything's contract. I mean, made everything else, all the contract stuff. So it may be low, but again, I would keep them in place. See if I can keep them in place, see how they do. And if that's workable, fine. But you're right. That's another threat there. What's the other side of that?
Yeah.
I don't know what percentage that is. Thank you.
Their current management fee is 2.1%.
2.1. I would think it should be at least 3, right?
Right. That's what I say. 3 gets you up around 130,000.
Yeah. Any other questions?
I don't have any question. Oh, sorry, Travis. I didn't mean to cut you off. You go first. I just had something to say.
Oh,
You go
go
first.
for it. Okay. I'll be quick probably. I was curious about the flat roofs and what everybody knows about that. I understand, those are problematic roofs, and I don't know how they underwrite them differently, or if you just account for a repair while you own it. I don't know how that works. I know Marcella has talked about it on the call or in chat or something before negatively and things. So just something to consider. I was going to bring that up, and that's all I can think of at the moment. Go ahead on that.
Okay, and that's fair. Well, as a former contractor, the roofing world has evolved a lot in the last couple decades, and some of these flat roofs, are designed to last 30 years plus. Some of our other operators here may have some information on that. I haven't walked a roof. I actually used to do some roofing back 30 plus years ago, but it's a whole different game now. They're doing applications. There's no tar involved. They're putting plastic sheets on roof basically. So it's not as big of a risk as it might have been, but depending on the class of property you're working on is going to be a huge issue is because you get into these older properties, it's just going to be falling apart, particularly in the Sun Belt, where it just takes a beating all year long. Up here, we have this nice cool air all winter long to let it recover. Just kidding. But so yeah, it's a valid concern, but I think a lot of that's kind of baked into your maintenance costs, and you get into an older building, you're just going to have a higher cost on repairing things, and it's one of those things, right?
Yeah.
This is a newer property, so that's not as much of a concern.
Brand
It's only
new,
3 years
brand
old.
new.
It's only three
Yeah,
years old, so I mean, until
yeah,
you get 15, 20 years on a flat roof, you probably won't have too many problems with it.
yeah. And now another piece on this that has been a question. Actually, when I first spoke with the broker, he brought it up front. Is that this is some people call it a clunky property, and the reason for that is it's 11 buildings, and they're spread out in a block and a half area. One of the buildings, interesting enough, is it was an office building conversion, but you can't even tell. I mean, they did such a good job on it. So it's I mean, you see the pictures there, and I think one Tim, I'm not in front of it, is the night picture, just beautiful picture. But
Oh yeah, that's what I had it
yeah,
up on. Let me get that back up.
I
Yeah,
mean,
that's the picture you want to show on your pitch
yeah,
deck.
if there's a sexy building, and I'm going to exploit that term, if there's a sexy building in the suburbs of Chicago, that's it with that view, right? Not saying everything's cupcakes and ding dongs all over there, but that's a beautiful property, well maintained, and it's well occupied. They're at 90. In fact, I think when I walked there, the gal said she was working on the final. They say 100%, but we only get 95. But they're going to full occupancy here in the next month, June 1. That's Monday. So yeah, so it's a highly desirable in that 3 mile circumference. There's not a lot, and in terms of new development, there's only one property coming online in the next year, and it's an age restricted property. And this property here is a lot of middle-aged people, working class people. So there's no competition coming online to be absorbed, so to speak. So it has that going for it as well. And that's that.
Hey, Kevin,
Yes,
this is
ma'am.
Denise.
Hey,
Um,
Denise.
hello. So you said there's 11 buildings. Does that make it like 12 units in each?
No,
Ish?
one has like 52, and I don't have the breakout. Tim has it there on the sheets.
Okay. Okay.
But phase one is the single building, I believe, and that's
Did
the higher rise building.
did you
They're all
submit an
mid-rise.
LOI?
Yeah, it was due last night. I submitted it tomorrow.
What? It was due last night, but you're submitting it tomorrow?
Yeah, that's Kevin time.
Hmm.
Yeah, no, I been working with the broker on this. That's another great thing. Thanks, Denise, for bringing it up.
You're welcome.
The broker, as I've been working with him, and now some of you have heard me say this, and I'll say it 1,000 times. I don't know how many folks we got on the call, but if you haven't been speaking with brokers a lot just yet, don't worry about being honest with brokers. I believe there's some places where fake it till you make it works, but this is not, I believe, one of them. I think it's best to be transparent. Not every broker is going to play, not every broker is going to want to spend time with you. But at the end of the day, if you haven't a clue, you're going to look like you haven't a clue, and you've burned a bridge more than you've built a relationship. That's my opinion, and I'm sticking to it. So this guy is the number 2 guy with CBRE in Chicago. So that means if the top guy dies, he's it. And I basically was straightforward with him. I explained to him who I am, where I'm coming from. Not that I'm the greenest of green, but in this game, I'm pretty darn new. I'm really started poking around heavy into this about 8, 9 months ago, and kicking the tires, and started digging in December. And as of January, here I am going full blown. And I told him more or less that. I said, but here's what I'm going to do. I said, this is my backyard. I'm going to build a market here, and I'd really appreciate your help putting something together, because if I don't get this one, I'm going to do something. And there's a whole other story to that. I won't bore you all with it, but the bottom line is very transparent with him. And I said, listen, I appreciate your help. And he started talking about underwriting stuff to me. And I said, listen, hold on. I said, you're talking Greek to me right now. And this guy happens to be like a hardcore underwriting guru. And he's hard. He knows everything. He's a master at spreadsheets. He said that, and I believe he could probably do spreadsheet underwriting in his sleep. So he's been walking me through stuff, and I have to slow him down, because when he was explaining some of the stuff on this TIF to me, I was getting cross-eyed, and he understood. So building that relationship is precious. And again, if I can bring this down, if I can put it together, I talked to him this morning, about I was supposed to have the LOI in last night. He said he's waiting for some others. I get further guidance from him on where to go with my offer. He knows my objective. He knows Grant Cardone. He knows everything upstairs and downstairs about Grant, because they've been dealing with Grant on Grant's attempt to do an acquisition up in Chicagoland. So I'm fortunate in that relationship. Once again, transparent. I didn't go into him and say, yeah, I'm on Grant Cardone's team. We're going to buy this property. That's bullshit. Don't ever do anything like that. But he actually brought up, because of the way I was structuring my deal. Get this. This guy's so sharp. I was talking to him about the 80/20 and cashing out and infinity and all this stuff. He goes, are you working with Grant Cardone? So sharp guy. Yeah, so it's been a great experience so far. And again, if he wants to invest in this property, 42 is a long fetch on this. But with the TIF support for the next 10 years, getting out in 5 to 7, leaving some meat on the bone. If we get appreciation, it's going in at a 6.1 blended cap right now. Leave it at that. I mean, with the cash flow, the way I see it, and this is just the way I see it with my novice approach, in 5 to 7 years, everyone will have half their money back. We do a refi at 5 or 7 years, depending on appreciation. We should be at a 150%, if the numbers work. If Tim gives me the right numbers.
Did you
No,
did you say why the seller was selling this one?
he's a developer. It's stabilized. He's ready to move on and do more work.
Okay.
Thank you for asking that question.
Kevin, have you gotten any deck quotes?
Yeah, they're 5. Yes, the answer is yes. There's a whole bunch of them, and again, how we structure that's going to matter. Not my area of expertise, but I think I wrote it at 5.5% interest only for the term for 7. I think that's what's on the sheet.
So I have a question. Your TIF goes till 2036. So you have incentive kind of wrapping up towards then. Now you were talking about 2038. Okay.
Yeah.
So you were saying something along the lines of, if you get all the investors' money out by then you just got cash flow coming in, and it almost, if we have appreciation, then it's good. But even if it kind of phases out and is very similar to the numbers that you have today, you should still be in a positive cash flow manner. So is that appealing to you, or is that what's your game plan there?
Well, I think it is. You tell me as an investor. I'm sure there's other deals out there that'll give better infinity returns, but at that point you'll have all your equity back. You'll be 100% in your previous position, and you just be cash flowing. You want me to sell it and give you a chunk of money, or just keep getting cash flow? It's up to you.
Keep it in and cash flow. That's
right?
What we want.
So if it's $5,000 a year or $50,000 a year, you tell me. Because it may at that point, and again, it depends on the appreciation. This is where you make the call. You get on the call with your investor and say, here's the deal, right? We can sell it now at this. You guys vote.
That's
Fair
nice. I
question.
like it, Kevin. No, I like it, Kevin. Thank you very much for bringing this to everybody. I appreciate it.
Yeah, thanks for your support.
Any other questions? That was a great deal. I love the deal itself.
I want to just
Now,
further kind of
here's the
give
thing.
praise.
Say again.
Go ahead, Kevin. You go ahead, Kevin.
No, what I need to do though is, and again, it depends on how the numbers come back, because I got to read. I was telling Jason earlier, I screwed up my underwriting spreadsheet, so I got to figure out what I did wrong there. But looking at the numbers here, I've got to make sure that we're providing a good return. The numbers have to work for the investors, and then what that offering price is, and I've got to zero in on what that's going to be. And then I've got to sit and figure out how to defend this against one Grant Cardone. So when anybody have any Grant Cardone questions for me?
What they buy?
Starbucks
What they
is.
buy it for, and what do they owe
What?
still?
Well, they built it. I don't even know.
What don't you like
Really,
about the property?
What don't I like about the property? The price. I wish it had more units. I mean, realistically, I wish it had more units. What don't I like about this property? One of those issues resolved. I mean, the thing I dislike most about this property is commercial units. That's it. But if I can write those off and there's still gravy, great. I have confidence that there's still going to be gravy. How long, I don't know. But the bulk of it is that these are like boutique style businesses, and they're unique to that area. The tenants support them, and then other people are coming in. The relevance of the market, where this is I'll call it a B market, the region just to the east of this is packed full of Eastern European immigrants. And they'll come over to this Ukraine. They'll come over here and shop. This is like a little escape from their neighborhoods. So I have confidence in these. There's like the salon, the spa, all these things. They're generating good revenue. They're all doing good business. The guy with the cafe was telling me his business plan. I got him to talk to me before he even knew I was looking at buying the property. And then I kind of told him, and he just opened up the floodgates on information. It's a beautiful thing. So yes, so the commercial was the biggest impediment to me liking this property or loving it. But now I'm looking at it, it's a brand new building, low maintenance cost. I mean, it's got a 30, I think I crunched into a 31% expense ratio. And that can be, obviously with the management fees and the insurance, that's going to pop up a little. So even if we put it at 35%, it's all new. Little tweaks. I mean, the lawn mowing and stuff like that, that the manager said the property, she had said that she wanted a swimming pool. I'd love to put one there, but that's not happening. Right. As much as it would make it even more appealing property in terms of this marketplace, there's no new properties going in the area. They're B and C all over the place. There's room, actually, the ones that do have, and I've got to look at these numbers again, but the nearby luxury level apartments are priced higher than this. So I believe there is room for upward growth. As long as the rent roll remains strong, I could see doing it. I think at 2% increments was my baseline. But even if it's flat, I mean, like Tyler asked, this thing stays flat, it's still going to be a great opportunity, because flat gives people 50% of their cash back just on cash flow in the next 5 to 7 years. They'll have 50% of their money back. We do a refi, they'll be at 100% return on their equity plus. So
What are you anticipating? What's the cap rate going in and what's the cap rate going out?
6.1.
Both.
So Kevin, you were saying that was a 6.1 blended cap rate. What do you mean by blended cap rate? You talking
That's
about
what
between
he
the
said.
retail?
Yeah, Tyler
You're talking
brought up
about,
the commercial cap rate and that. I think that's where they
okay.
come up with that. So I told him I was going to put it at 6.1 in my underwriting, and he didn't disagree with me. The
I
underwriting, the finance
personally
guy.
I like the retail space underneath. I would enjoy
Well,
living
that's
somewhere like that
because
had a
you're
cafe
crazy,
or
Denise. Well, if I've got a great apartment for you, and then you can
I know
manage the restaurant
I
I buy
can
across the
property
street.
manage. And a swimming pool is not ideal because what you got
No,
maybe 3 months in
no, yeah,
Illinois.
Sell me a
You'd
boat.
have to be
No, don't sell
indoor.
me a boat either. Yeah, well, people still like them though. But that's another thing on this. And there's pictures up. There's a few pictures. They don't do a really good job. I think in the nighttime picture you might see it, but the largest building there has this huge
The
deck
mute button.
common area. It's just a really nice deck, and it's the entire circumference of that main building.
See if you can find another great picture of the
He's been
asset too.
talking about his deal in Chicago.
Yes, I am.
Yeah, see if you can find a sexier picture, Kevin.
What about that unicorn up there? That's pretty
What
sexy,
about,
huh?
It's okay.
what about this one without the stuff at the top?
I don't see it.
Yeah, we're not seeing
Oh, you
it
don't
yet.
see it?
No.
Oh,
That
maybe I'm not
unicorn
sharing
will be
anymore.
his logo at the top of the building.
Hey, Sid.
There.
Hi.
Yeah, that's
Just
an
this
easy
part here.
one.
And it's okay. Maybe,
Well, that's the building right there, front and center.
yeah.
It's a night
Well,
view of
there's
it. So you see that
11
whole,
of them.
there's a little, well, the big building right in front there. You see that lighted atrium area?
Yeah.
That's like a little lounge area. You can rent it out. But that's just like a pop-up in the middle. And then all around it, that entire thing is decking. And I think this thing might have been a winter picture, so there's not all the furniture and everything out there. But yeah, it's pretty cool.
Yeah. What is this on the left-hand side?
That's
Train track.
that's the
Huh?
choo-choo train.
Train track.
Oh,
That's the
okay.
Metro. That's the regional
Got it.
Metro rail.
Oh, I can
Another
see it better
question?
now. Okay,
Another
yeah.
question came up, and I asked residents, the manager, and the guy with the cafe about the train noises. And they said if there's any other maintenance issues, yeah, it's going to happen. Because he said the main complaints are like typical construction type things where it wasn't done quite right. But he said the one thing that's really awesome is the windows are soundproof. They did a really good job with
Well, that's
that.
nice.
So yeah,
And if you live there long enough, you get used to the noise.
darn Skippy. What train?
I like it.
Called the L, right?
Not out there. The L is actually the city trains. So they branch out, they spider out from downtown. The loop is actually the name. The loop in Chicago is reference to the loop that the trains go around downtown in. There's a loop, actual loop area. Several of the trains go through that loop and back out into the other parts of the city. The regional trains are called Metropolitan Train Authority.
Well,
Metropolitan Rail Authority, I think.
get your LOI in, buddy.
Well, I'm still waiting on. I've got to get back into my spreadsheet here and fix it, and then I'm waiting for feedback from a couple more people because I don't want to go in and even though he said I've got a week to rework the numbers with him, I think I have a really good chance of getting best and final on this. So
Yay.
I've got to make sure that my numbers are right so I don't have to dance around with this and understanding I need about $15 million.
Want to give you props, Kevin, for doing most of this presentation while you were commuting home. I think that, that just kind of speaks to the fact that you're in the know of this, you know the story of beyond just the property. You got the story with the broker as well. And you said that you're planning to, if everything continues to go well, bring this next week down to Miami.
Yeah.
I will look forward to seeing it and you in person. I'll be there as well.
Thanks, Deontay. But there's more. One of the top-rated hot dog stands in the country, Gene and Jude's, is within a mile's drive. So it's like a 7-minute drive to get the best hot dog in the country. Just a bonus there for y'all.
You're going to want to
But
time yourself for a grant presentation though, Kevin.
no ketchup. No ketchup. I have a 3-slide presentation for Red. I've
Okay.
learned lessons from so many other people. Thank you. I do not. In fact, I'm hesitant to do more than 1 slide with Brent since he comes up and throws up these slides and
I mean, that one's pretty good.
just like I did with 1 slide, right? Yeah, but
And I would recommend saying,
You
I
need
would
to do
recommend
that.
saying as little as possible too.
Yep.
Yeah.
You need to
it's
do it.
just
You
like,
could probably do the whole thing with this slide right here. Just put the numbers in the
And-
bottom, get rid of the CBRE.
well, that slide and the night slide.
I'll bet
But
the
Tim, you're right.
broker. I'll bet the broker knows what Grant wants for a picture.
He and I have talked about that.
But
He knows
you know
Grant.
he's gonna
He knows Grant.
you know he's gonna complain about the Grant's gonna complain about the picture if he's looking.
You know, what, I think I'm in the right place because if you saw what Jason did to take apart Grant Cardone, and I'm just saying that kiddingly, but Jason defended his property against Grant Cardone, a property in St. Louis, which Grant does not have any love for.
Yeah, Jason rocked.
And Jason Stillman, to this day, that was just one of the most impressive stand your ground situations I've ever seen.
That was good. That was super good.
Yeah.
Right on.
That and anything with Tim in a swimming pool.
You know, I have to admit, I remember that pitch too, and I really liked it because of the way it started.
Yeah,
With the F-bomb, right?
So,
One
It's
thing
a great
about it,
pitch.
I don't think anybody's ever started one that way that I've seen.
that was great. Core memory, guys. Core memory and gals.
Or trauma.
And see, we're still
either
talking.
one.
We're still talking about it. That's how memorable it was.
It's either memorable or traumatic. Either one. I don't know.
So
Definitely a great icebreaker.
back to the broker too, since we're off on storytelling land here. I hate to take you guys to so many of these. So the broker said that his name is Justin. Anyway, he was crabbing on me a little bit. He was the victim of one of Grant's live calls from the stage.
You're doing it.
So, and I say victim only because he kind of knew what was going on, but he didn't want to say anything because Grant was being a little bit, you know, if you've ever seen Grant make a call from stage, he gets a little dramatic. So yeah, this guy he was torn apart by Grant on a live phone call, a live stage call. So it's cute. So he really knows Grant, and he's jovial about it. It's just it was good that it's good that he brought this up, and it helped build our relationship. So I got really fortunate in that situation. So anyway, I really appreciate you all for indulging my prattling on. I could talk another 2 hours about random items, but this is
We're going to cut you off right here.
Did everything Next Legacy's doing. Thank you. Thanks, Jason. Thanks, Tim. Thanks, Teresa. Thanks, everybody.
You're welcome, Kevin. Great job. All right, I got one more. It's actually going to be ours. I'm going to turn my video off because the internet in this hotel sucks. So if I pause or freeze, I don't want to have some weird face. So I'm going to shut my video off and then share my screen and then walk through something slightly different than what you've just seen. Okay, can you guys see?
Yes.
Yep.
Excellent. All right. So I want to walk through something. It is real estate related, but is a little different than what you guys are normally see. And so the Next Legacy Group is here to present a secure note program. And it's real estate backed. It gives monthly distributions of cash flow anywhere between 6 and 12% annualized. So I'm going to walk into this. If I freeze it all, give it a second, I'll come back, I swear. And then the rest of the group can always fill you in as well. Disclaimer. I think you guys all know disclaimers. you know, everything has risk. Every deal that was presented today, we talked about at the beginning of the call. You guys know us, love us. Tim, Teresa, Laura, myself, and Justin. We are the Next Legacy Group. This is just kind of a slide about us, our partnership, and what our roles are within the company. Track record is always important. This is something I like to show on slides. It helps people ground people. Vasily did it. He talked about his groups and track record, and it really helps validate and ground folks onto what they're actually investing with, and that the folks actually have experience and know what they're doing. So we have 21 acquisitions, 8 exits, 150 assets under management. The 4,000 plus units is invested and owned, so both as LPs and GPs. And then the results speak for themselves. They're quite incredible. Most of the multifamily properties have been held for less than 30 months. They've had an average equity multiple of 2.4x and a mind-blowing 56% average IRR. So let's talk about the program. It is an amazing program. It is very simple to understand. It is basically a secured note. So we have equity within the properties that we currently own. That equity exceeds $15 million and is available to loan against. And so we are offering something slightly different than what you see as an equity position. This would actually be a debt position. It's guaranteed to the point that you can guarantee anything. It's a guaranteed return of 6 to 12% annual return on your money. So what that essentially means is constant cash flow, and it is backed against real estate. So your money's secured against the real estate. If anything were to happen, the real estate is what is backing the property. So therefore, the real estate would get liquidated and you would get your capital back. So it gives you a much more secure position than an equity position. It gives you a monthly return of a fixed 6 to 12%. The way the fund is basically going to work is you're going to invest in the fund. We're going to issue notes from the borrower, which is against our own property. And then we basically just start paying you a return. So I will go into a second about what those returns look like and how they function. And then it's paid on a monthly basis on the 15th. So I know cash flow is talked about a lot. This is cash flow, and that's what the purpose of this really is. So kind of talking about smart money in general. So like you have your savings account that gets a 3% yield. You have the stock market. I mean, man, I play the stock market. It's all over the place. I'm watching stocks go up, go down. I get sick, I get happy. I'm not sure what emotion to have. And so that to me isn't where I want most of my money. I want something stable, something that's giving me cash flow on a regular basis. If I decide to retire one day, I want to know that I have constant income like I do with my W-2. And then real estate equity, that is my long-term positioning, and that is where I want to grow myself long term. But this opportunity really gives me a constant cash flow return that I know I can get each month. So this is kind of how the flow works, right? The investor funds the secured note. We back it based on our property, and then we distribute the money on a monthly basis, right around the 15th of each month. And it's that simple. It's you loan the money, we give the promissory note, and then we start the returns. Again, it's real estate backed. So here's kind of how we split the returns and how we have the actual rates. So we have 6, 8, 10, and 12%, and that's basically based on the amount of money that you invest. So up to 50,000, 6%, between 50 and 100, 8, over 100, 10, and then if you hit that max and you deposit over 250, you get a 12% annualized return on your money. Now, one of the cool things that we were doing is I know some of the folks here have invested with us on our previous deal, the Haven. we would actually count whatever your balance is with us today towards whatever interest rate that you see here. So for example, if you invested 50,000 with us at the Haven and you wanted to put another 10 in, we would actually issue that to you at an 8% rate because you would have a total of $60,000 with us. I throw this slide in here really just to talk. I know you guys already know this, but some of the folks that we talk to, it's really getting them to understand why you want to diversify sometimes your portfolio. One of the goals when we set up our fund on Investor was to be able to offer our investors multiple ways to earn cash flow and returns. And so the first thing we did was obviously the equity play with the multifamily property. Now we're offering a debt option that will be able to, it'll be something slightly different and it'll be secured against assets that we own. And then hopefully we'll be able to do more diversification within the fund itself so that we'll be able to offer you multiple things. One of the things that we talked about in the beginning was if you know the app Robinhood, and that's how you can invest in stocks, you put your money in, you pick whatever stock you want, whatever stock you like, and you can keep trading and buying and trading and you always keep your money in there. Well, that's the thought, just on a different scale for us. It's like, hey, you'll have equity in multifamily properties, you'll be able to do debt. Who knows what else we can come up with, maybe crypto, don't know yet. But it's really just helping you diversify and really be able to pile that money away so that when you decide to retire, like it says here, that you'll have that income coming in. This is kind of a little bit about ourselves, right? Look, our goal is really to acquire real estate, renovate them, turn them around, get returns for our investors, and then really bring that experience that we have based on the properties that we've purchased and owned and worked with our property management company as well, and really focusing all of our efforts into making the best available investments for our investors. And this is just call me, call Teresa, call Laura, call Tim. Come hang out with us, invest with us. It's really just a way to continue to build your own portfolio, to spread out yourself amongst different things, but still stay in real estate. So I did it really quick. What kind of questions do you guys have? And let's see if I can see anything. Or did I lose everybody? And you're like, ah.
You did such a great job that nobody has any questions.
One thing
I did not curse.
Jason, why are they selling?
To fund more multifamily properties. That's why they're selling.
One thing that I think that we'd like to add is that if your funds are in this debt option, when we funnel in to our overall fund another multifamily equity option, you can roll that money over from the debt to the new equity opportunity. Even before your 1 year lease term or note term is up, if you choose.
Great point, Laura. It's basically a way for you to continue to grow the money so you can park your money for a year here, collect 10% on your money. There's an opportunity to invest in a multifamily property that we've put together. You can then take that money plus your 10% and then put it into that multifamily property.
So the advantage of that is, a lot of people are worried about putting their money somewhere and then all of a sudden seeing a deal come up and not having access to that money anymore. Well, with putting it here, you can do best of both worlds. You can park it somewhere that gets you a good return, and then we're only going to have the best deals. And so when they come up, you'll be able to just roll it right in, and you won't have to worry about not being able to pull it out. So not a lot of ways you can do that in other investments.
One of the things that this addresses too is liquidity. when you get into a multifamily deal, you're illiquid for at least 5 years, depending on how long the plan is. And so I think some people want some available options. Yes, you want a bunch of investments in real estate and multifamily long term, but that makes you illiquid. This would keep you liquid, right? Because you only have to do this for a year and it's collecting an interest and returning you a monthly cash flow. So it helps people who are less hesitant, don't like the longer term play. And, it gets them used to the actual distributions on a monthly basis. And then maybe to, like Tim said, the new property comes up, it's got a great return, and you're ready to move into that 5-year hold.
Tim, Margaret's asking about our funnel and we're gonna talk a little bit about our buy box and properties you've been underwriting lately.
Yeah, we've got quite a few on our list right now. Kind of working through many of them. Most of them are in the Kansas City, St. Louis area. There's a couple I'm looking at in Des Moines. I mean, and they range pretty much from 70 unit deals up to we were looking at one the other day in St. Louis at a great location in St. Louis. It's actually over a 300 unit property. Not usually one that we look at, but it just kind of stuck out to us because it's not too far from the one that we're getting ready to close on now. So having another one in St. Louis would make a lot of sense. So yeah, I mean, we've got several looking at right now. We haven't really made any offers on any recently. But yeah, they'll be similar to the ones that you've seen us do before. So
Tim, have you guys looked at Martin City?
not sure. Which one is that?
Martin
Do
City
you know the
Flats.
name of it?
It's Martin City Flats.
I think I did see that one. I didn't have that one on my list though.
200 and some, 280, I think, 282 apartments, I think, units. I'm just curious. So this sounds like more of a mutual fund type situation. So I'm curious about how you set it, like, how do you protect your investments? And it sounds like nobody's really like they're not an LP in an apartment building specifically. It's just
No, you're not an LP. You're basically loaning. It's private debt. You're basically loaning your money
mhm.
out, and we're
Okay.
securing your loan via real estate.
And it's a minimum term of like 1 year.
Yeah, it's a 12-month term.
Well, I love it. It sounds like a great idea.
We
Right.
like
So if you
to,
put,
it really likens to, if you're a CD, if you've got money, maybe you're saving money for a house and it's sitting in a savings account or a money market account or even a CD. I mean, I looked at rates last week when I gave a presentation on this and savings average 0.38%. So you're earning 38 bucks on, $100,000. So that doesn't make up for inflation by a long shot. And then if you look at CD rates, average CD rates right now are high threes. Maybe you can get a four if you've got a good relationship with a bank or institution. So I mean, when you contrast to us that we have 6% as our entry, and keep in mind this is liquid. We intentionally made this a 12-month note so that you were able to, do something else with your money. And I saw that the question just came in about Roth and IRA. Yes, we're set up with our customizable fund to be able to accept any kind of self-directed IRA money. So we can certainly work with you on that. That is no problem. We did it on our Haven property, and we can certainly do it on our debt property as well.
yeah,
And
and
I
I'm
think
sorry, I
Brandon has
froze.
a question.
Yeah, Brennan has a question. I'm sorry, I froze. So
Yeah, no worries. So I know you said that these are secured by the real estate that the partnership already owns. Can you talk about what types of loans you'd be making to generate the returns, or is that something that you kind of determine as you go? Do you have a particular target for types of loans you want to extend?
Yeah, so we'll be loaning right now. The initial plan is to loan to one of our partners that has assets outside of our ownership, our current ownership, and he has the equity in those deals is what he's going to put up against these loans. So that's the other good side about it is we're not loaning this to somebody that we don't know, and actually loaning to somebody that has a vested interest in this fund as well. So yeah, just kind of a double secure way of loaning the money out.
Sure.
And he's gonna use it for basically making improvements and upgrades to those properties.
So
Excellent. Then go ahead, Laura.
go ahead, Brandon.
I was just going to say, is there some sort of security for you guys with that loan? And then like is there like some kind of lien position on his equity that would be held as security for the loan? How do you guys plan on managing that kind of thing?
It's through a promissory note, basically. He's signing a prom note, signing the equity, you know, for the amount that he's borrowing from us. So
But it
is
would
that
be
what
in
you mean?
second position.
It's a
Second
second.
position for
Yeah.
you.
Sorry, I keep losing you
Yeah.
guys. It's a second position loan.
Yeah.
Okay, just curious. My other
Mhm.
question is there now, or do you plan on offering the opportunity to leave your returns in the fund for compounding?
We don't currently have that written in, but we have discussed it and talk about how we want to manage that. Honestly, we need to get our handle on how investor allows us to handle that. So once we kind of jump in, as of right now, we're not doing that, but we have talked about it and discussed it that we'd like to be able to do that as long as we can manage the math behind it, if that makes sense.
Yeah, for sure. Awesome. Thank you.
Thanks, Brandon.
This was a way for us to help our investors, right, in our fund instead of going to the bank to fund their CapEx projects. This is what we're offering to our investors. So, and the interest that he would have other been paying the bank, he's paying you guys. So this is just kind of a win-win for everyone. Way for us to help you guys out and get the CapEx work done.
Awesome. It's a great idea.
And another thing, because we're inside that customizable fund, for those of you, I know we have several on the call that are invested with us. You can add in money once you're invested with us. But here's the beautiful thing, Carol, you're going to love this. You don't have to do the paperwork again, sister. You got the paperwork done. All you got to do is just sign the one little document and then you're good to go. So, and that is nice because our PPM covers everything, our subscription agreement. We wrote that with the idea in mind that we were going to be able to add debt and other things to our fund. So we do what's called a deal disclosure, just so you guys understand, or an investment disclosure that talks specifically about this debt opportunity. And that way, that's the only thing that we have to do. So even if you're coming in through, like a SDIRA or whatever, if you've got a self-directed, the paperwork doesn't have to be done again. So you guys will be happy about that.
And on top of that,
Fantastic.
as soon as you invest, you will start getting your returns the very next month.
Hmm. Good to know. Okay. Very good.
One question, it did look like I think on your slide, it looked like you put 0 to 50% or something like that. Is there a minimum? What's the minimum?
Minimum is 50K.
Oh, okay.
With the exception of if you're already invested with us, we would take a lower amount. All right. What other questions do you guys have? And I apologize for the terrible hotel internet. Doesn't like me today.
I like this idea. And your
Thank
internet
you.
is fine.
Yeah.
It's fine now until I go
It is.
like this or something and I'll freeze like this, you know? That's a
I want to
weird.
know where you are.
I am in I think that's it's Hollywood Studios and Disney behind me in Orlando.
Orlando. Cool.
How much are we going to put you down for, Denise?
Yeah. Oh, me?
Yeah.
At least 50. At least 50.
Okay.
I'm in this time because I'm kicking myself for not going in earlier.
Yeah. There you go.
Yeah, it's a great idea.
And Jason, you said there are no fees of any kind for that debt fund.
Jason just locked up
Did
and
he
got cut
froze?
off. Yeah, he froze. He froze right when you asked that question.
I
No,
timed
there
it
is
perfectly.
not, Brandon. That's correct. No additional fees. Everything that you see is the money that you'll receive.
Denise
Thank you.
jinxed me. She said I wasn't going to freeze and it kicked me completely out.
And there it goes.
I did. I jinxed you.
Thanks, guys.
Sorry.
Yes, and we can share the deck, Joe. I just saw your question.
Thank you.
All right. Well, I think I froze again.
So
Nope,
wait,
maybe
You're
not.
good.
Jason, you're in LA area, right? Is that where you're at? Or are you in
No, I'm in
Florida?
Orlando right now.
Orlando. Okay. Okay. Sounds like you're on holiday, or are you guys looking at properties?
I am both. We're looking at properties, and I am quote unquote on holiday. We just drove down here. I live in Jacksonville, so it's like an hour and a
Perfect.
half away.
Is this a graduation gift, Jason?
Oh, you froze again.
You're okay.
We can see you
Oh, now he
or hear
froze.
you.
Now he froze.
Oh,
So Mickey
there.
Mouse clearly doesn't pay his internet bill. Seriously.
You're not
No, they
supposed
need
to
you
be
to pay to the
working.
next. They need you to pay the next level. That's what they want you to do.
Yeah,
Pay for
well,
the fast
I
stuff.
did. I paid for the premium too. This is terrible.
You're not supposed to be working
Oh,
when you are on Disney grounds.
now you got to get
That's
your money
probably
back.
true.
Yeah.
Yeah, share the deck with me. That'd be awesome, and then I can come back with questions or set up a time with you all.
Yeah, me too.
100%. I will. We will send this out to everybody, actually.
Well, thank you, everyone.
Yeah. Well, I appreciate all you joining. Thank you very much. Hopefully you all have a great weekend. And if you need anything, always feel free to reach out to us and then join us next Friday. And I froze again. Did I froze? Okay,
Nope,
maybe.
you're good.
Thank
You're
you.
good.
All right.
Thank you,
Bye, guys.
everyone.
Bye,
Have fun.
everyone.
Bye-bye.
Have a good weekend.
Thank you.
Very good, guys. Thank
Thank
you.
you.
You guys.
Y'all have wonderful
Thank you,
weekends.
everybody.
Ciao.
Bye.
Ciao. Thank you. Bye.
See ya.
Mhm.